Hello everyone and welcome back to the channel. This is Fair Value Finder and today we're taking a look at a requested stock, and that stock is the Cigna Group, ticker CI. This is an insurance company, and we're going to look at this like we look at everything else, pull out the numbers, see what a fair value would be, where it'd be overvalued, and where we'd have a margin of safety where we'd be looking to jump in. And we're going to start with the chart here. So you can see that there are some lines on here. That red is overvalued, that yellow is the fair value, and that green is our margin of safety, where we'd be looking at buying it with how it's performed over the last few years, what's expected this year, and what's expected going forward. So we see that it hit a peak right about at its fair value, its current fair value, that is, back in late 2022, and has been on the decline throughout most of 2023. Fell all the way down until it hit this support line that it had quite a bit of resistance back in mid 2021, and then it fluctuated around there for quite a bit in mid 2022, and now in mid 2023 it's using it as support. So it definitely bounced off. Looks like it's staying above that. It kind of hit a more long-term trend and rose above that, and that's what we're seeing for the technicals. So it's definitely got some good solid support down there at the $255 level. Our margin of safety is around 270. So down at that point would be a decent point to look into buying, especially with the trends that we're seeing here. So if I were to try and trade this stock, I think that there's potential for a put credit spread using that 255. So I would go one strike lower than you could get to 255 and open a put credit spread there. So maybe in a trade video, I'll take a look at that and see what kind of profit that would net us. I'd want something at least 10%, because put credit spreads do tend to be a little risky because the market is quick to move down and not as quick to move up. But that's what we're looking at here. It's currently trading within the realm between margin of safety and fair value, so it's okay. It's kind of at like more of a hold price. You can buy more if you want, especially if you were to make some money off a trade, throw that into shares. But we can get into the numbers and see where exactly all of that is coming from and why I'm saying that those are the regions. So we'll go straight to the metrics. And this is all based off the earnings, cash flows, balance sheet, and dividend. So the majority of the value is coming off that dividend. I mean, it's only yielding at the end of last year 1.35%. Currently, looks like it's yielding 1.7%. Historically, not a huge yielding stock, so that's why that's boosted up so much. And that is being followed. That's being followed by the cash flows and the balance sheet not too far behind that. The free cash flow yield is okay on this company. I'd like to see it a little bit higher, but that's fine. Both the earnings and cash flow yield they're decent. You're looking for something that you'd want to be your return. So in today's day and age, we'd be looking for something above 5-6% on both of those numbers. And then there's the earnings, where the earnings make up the smallest part of the valuation here. And that is because they're expected to bring in $24.69 per share, which is only 8.5% of the current share price. But with how all of this breaks down at the end of 2022, we would have been looking at a fair value around 288 with a share price of 331. So it was more on the overvalued end. In fact, it was above our overvalued metric. And I mean, that would warrant a sell-off going into this year if it were overvalued. We might have to look into earnings to see if they're actually going to hit these targets for 2023 and 2024. But if they are capable of doing that, these numbers shift quite a bit. That fair value goes from 288 to 333, and the margin of safety moves from 331 to 231 to 267. The overvalued moving up $47 from 300 to 347. So there's some nice moves in these numbers over the 3 years that we're looking at. And then to try and get a gauge on where we can really get into this stock, we take an average of the last year that we have full numbers for. Since we're halfway through this year, we take that and then the expectations moving forward for next year. And that's giving us our regions. So the big thing to look at is anything in orange. So revenues, we're looking for some nice growth there. 5% isn't ideal, but it's good enough. We want that to be at least more than inflation, preferably even more than that. Double digits would be nice. Expenses as a portion of revenue, we want to see that be something that is going down ideally. And it looks like they're kind of all over the place with it. Essentially 96, 93, 96, 95. So there's no clear direction for that. Earnings per share, they have been doing pretty well at growing that. They did hop up in 2020, going from 13.58 to 23.17, and then back down to just shy of 16. Now they're trending back into the 20s again. The share count, that's something that we want to see declining, where they're buying back shares, rewarding shareholders. They have been doing that at a very good pace, just over 6% a year. They've been buying back. Free cash flow yield, we've already touched on. We want to see this really above 5. They are not huge on their cash flows. They were better back at the start of our time frame, and more recently, like 2021 and 2022, were not great years. Tangible book value, ideally we want to see this as a positive, but this is an insurance company, so financials are very different and their liabilities help to bring in money for them. So it's something that we can't look too heavy at on a financial company is the balance sheet. So we're going to give them a pass on their debt to equity and their tangible book value. I mean, ideally, we'd see this trending in the right direction. They made some improvements in the debt to equity from 2021 to 2022, and they have been getting worse since 2020 on their tangible book value. They had made some big strides from 2019 to 2020, and then have just been on the decline since then. ROE, this is something where we want to see the return on equity being at least 20%, ideally. And we're not really seeing that. We're seeing consistency in the teens. I'm seeing a lot of 11s, 16.8 and 14.9. So when they come in this year, let's see, is this drag? They'd be coming in this year if they hit targets at 16.5. So that would be one of their better years. And that's what we're looking at here. So all of these metrics are kind of okay. I mean, this isn't going to be a huge growth undervalued play. The stock price is definitely towards the undervalued end when you're looking at the fair value. They've bounced back. They're back above that margin of safety. So it would have been best to have gotten into the stock when they were hitting that support level. The people who held that support at 255 will be rewarded. They already kind of have been, and they're up $32. So they're up over 10% over the course of 2 months. And we can look at the trends for everything. Revenue, great trend. There is no gross profit because this is a financial company. They do their finances a bit different. I don't like that there's no real pattern here in the EBIT. It's just up, down, up, down. The net profit is the same story. So that is something that they're not showing much consistency for, and we really want to see a strong, consistent company. Assets look like the assets are trending down, and the tangible assets are remaining pretty flat and negative. The liabilities do seem to be trending down as well, and tangible book value pretty flat and negative. Cash flows, no real pattern here. Looks like a reset in 2020, and they're back on the rise. We'll see how that shapes up going forward. Dividends, they paid really small dividends 2019, 2020, and they have been raising it rather quickly since then. So that's something that we'd want to see them continue. And we'll see if they make one of our dividend raise videos, how that is playing out. And then our graft prices. So, of course, paying that low dividend, it was not adding much to the value, and now it's one of the highest value metrics that we have here. It's nice to see that the fair value is smack dab in the middle for most of this. It has overrun the book or the balance sheet, which has been pretty consistently growing. The earnings, we kind of see the story that we've been seeing where there was a 2020 reset and they've been on the rise since then. Looks like that's the story for the fair value and for cash flows as well. So when we look at the actual share price here, we do see it's typically one of the lower values here. And that's not a major surprise for a financial company such as this. But it looks like it trades pretty well in line with those earnings aside from 2020. So if we factor that out, we'd be looking at this stock having some decent upside, at least 10% from where it is today, would bring it more in line. We'd probably be looking at 10 to 20% to bring it up to more of a fair market value. Now, is it a stock that I would be investing in? It's got a very low starting dividend yield. Its cash flow yield isn't super high. The earnings yield is pretty nice. And the earnings are something that they've been rising very quickly. So with all that, I'm leaning more towards a buy, but financial companies are notoriously difficult companies to make money on and truly value. So it's probably going to go on the hold list. There's clearly some upside to it, and I'm sure that the shareholders who take risk will be rewarded, because this thing might be going back to test that 330, 340 level again, and it might break through this time, in which case we'll see if it can go to 350 and how the valuation metrics go from then on out. Because if it can make it through the rest of this year on the trend that it's currently on, by the time it hits the fair value and overvalued metrics, those lines will likely have been shifted upwards. If I were reviewing this stock a few weeks ago, back when it was down here at the 260, 250, $260 level, I probably would have been more inclined to say buy. But it's already gone on its run, and over the last 2 days, the whole market's been red, but that could lead to a bit of a pullback from there where we might be able to see a new entry location. But that's what I'm seeing for this one. So please like if you enjoyed the video. Comment if there's any other stocks you want us to take a look at. Subscribe so you can stay up to date on everything, and I'll catch you next time.